Hello everyone. Over the next 20 minutes, I want to walk you through the RBI's June package, the FCNR B window, the ECB liberalization, and the overseas bank borrowings. And more importantly, what is actually inside the headline numbers. Let me anchor you with four figures. First, the swap window has mobilized 65.40 billion of FCNR deposits as of 21st August. 90% of everything the facility has taken in. Second, $31.10 billion of that arrived in just the final 8 reported days. Banks are sprinting to the 31st August close. Third, the reserves stand at $716.9 billion, seven straight weekly gains within $12 billion of the record. And fourth, total receipts across all three channels is $72.85 billion. Hold this last number in your head because the question this next keeps coming back is a simple one. How much of it is real money and how much is manufactured? Let's start with the this deck. So here the total numbers that have come so far. Up to 21st of August, three channels. Total amount is $72.85 billion. Look at the mix. 65.40 is FCNR deposits, which is around 90% of the total volume. And then there is overseas foreign currency bonds, which is around $4.86 billion. And rest is ECBs, which is raised by PSUs. It is around $2.59 billion. On the right, you can see the pace, $36.7 billion by the end of July, 52.3 by the 19th of August, sorry, 13th of August. And if you see the graph, it is a steepening one, not a flattening. For the scale, the entire 2013 window, the one we all remember as a success, raised 34 billion. And this one has done more than double that, that in 11 weeks. And the pace is exactly why RBI is pulling the deposit window forward, closing it on 31st of August, a full month early. So how did we get here? So let's see what RBI changed in just one picture. In June, RBI changed one simple thing. It took off the hedging cost from the bank's books and it took the overall cost on their own books. It also removed the ceiling of on FCNR deposits. Earlier, there was a ceiling that banks can charge up to around alternate reference rate plus 400 or 500 basis points. They removed them at the in around 17th June 2026, and it is valid till 30th September 2026. And they also have given the opportunity to PSUs and banks, that they can hedge their foreign currency bonds and ECBs at 1.5% concessional rate, swap rate. So out of 3.5%, the market hedge cost, which is at present, it is right now, they can do this at a 1.5% swap rate. So what happened? The FCNR B became cheaper. So the banks could provide FDs to the NRIs at a higher rate, which is around 6%. Some of the newer banks are providing up to 7.10%. And since after starting this scheme in 11 weeks, RBI raised around $72.85 billion. And since a lot of money was coming here, then RBI has to close this lag early by end of 31st August 2026. So, whole story in one simple line: the RBI moved the hedging cost of banks' books and onto its own forward book. So let's see, why did every bank suddenly start bidding for FCNR money? So only one questions, number explains it. The 200 basis points. What is this 200 basis points? If you see on the left panel, you find out that the FCNR rates were lower. The banks offering FCNR rates at a lower cost, and they had they need to hedge this as well. And the overall cost for the bank would be equal or approx 6.85%. And in domestic market, they could have raised around 6.3%. The FDs the rates they were providing in domestic market, it was around 6.3%. If you see on the right hand side, you see that they are able to offer even higher interest rates to the NRIs because they don't have to worry about hedging cost. So please keep in mind that this is the FCNR cost which is being borne by the RBI, and the bond cost is being absorbed by banks at 1.5%. So when a bank pays more for dollars than it needs to, it is because someone else, in this case, the for central bank, it is paying the hedge. Keeping in that mind when we get to who actually funded these deposits. So let me make the mechanics concrete. So here three balance sheets are moving in line. So you need to follow the six boxes. Suppose there is a one RI sitting in Dubai who is holding dollars. In step two, what are they going to do? They are going to place in a 1 to 5 year FCNR deposits. And to qualify for this scheme, they need to at least put term deposits at a minimum 3 years of tenor. And since this amount is exempted from CRR and SLR, the banks will give it to the RBI, and RBI will give them the INR. And there will be 1 year lock-in period, which will be non-cancelable. And RBI receives these dollars, and the RBI will add dollars to its foreign exchange reserve. The net forward position of RBI will lengthen, and RBI is going and the banks are going to deploy this money, because if they are going to save money, so in CRR or SLR, they need to keep the money, and this money they can deploy in the market. They can provide loans on the basis of this money. So a lot of money will come to the market. So so here nothing is free, and at the maturity, what is happening? The machine reverse and reverse. RBI returns the dollars, and the bank repays the NRI, and it is very profitable for NRI because they get higher interest rates on their deposits, and they are also able to leverage it. So that's why the return on investment becomes higher, and sometimes it can also beat the market without taking the risk. The country risk remains there. Now look at the who moved what amount. This table is a bank-wise split table in Parliament, the only official breakdown we have, covering the 5th of June to the 13th 30th of July. Start with HSBC from 120 million outstanding to 6.25 billion. A 50-fold increase in 8 weeks, nearly a quarter of all in net inflows in the economy. Foreign banks as a group took 30% of the flow from less than 2% of the starting stock. SBI led the public sector banks with just over 4 billion mobilized under target set by the Department of Financial Services. ICICI added another 3.7 and our own book went from 4 billion to 5.5 billion. Since table was compiled, receipts has climbed to 65.4 billion. So treat these shares as the share shape of the race and not the final standings. But hold one question as you look at these names. Why did the banks with the smallest NRI franchises grow the most? The next slide answers it. So this is the slide the headline hides. Give it a moment. Of the 36.7 billion collected to the end of July, our estimate is that only around 3 to 3.7 billion is genuine NRI savings. The rest is bank manufactured. So here is a trade. A bank leases property or a portfolio. The bank lends 9 to 29 times the bank client's own money offshore in dollars, and the loans come straight back as an FCNR B deposits in the same bank. On HSBC's published terms, 10,000 your money, 190,000 of theirs. For every $100 NRI actually brought, banks created 900 to 1900 of deposit. So why does it matter? Three reasons. On left, first one, it is not a new forex. The dollars are circular. So net new money for India is roughly the base. The RBI swap cost for about 3% on the full book works out to roughly 31% a year on the real money. Two, the maturity wall. In FY29, the 33 billion of loans and the deposits behind them unwind together. Three PSU banks were pushed in at 9 to 10 times leveraged by the ministry targets. And to tell the reconciliation, outstanding stocks rose only 28 billion in the table data, not 36.7. So one of the articles published by Keres, it is said in plainly that leverage as high as 19 to 29 times supported the stronger than expected participation. You are not looking at 36 billion of NRI confidence. You are looking at 3 billion of NRI money and 33 billion of bank arbitrage. That is the point. So our question. So where does real NRI money actually live? So RBI does not publish country-wise FCNR data. So the best official proxy is the remittances survey. And it tells a story most people have missed. The map has flipped. The US, UK, Canada, Australia, and Singapore now send more than half of India's remittances. The Gulf share has fallen 10 points in 7 years. The UAE alone from 27% to 19%. The UAE alone fell from 27% to 19%. That shift matters for this product. High income, dollar earning professionals in New York and London are exactly the audience for a dollar denominated tax free deposit at 6%. They face no currency conversion, no rupee risk, and no taxes. But notice the tension with the previous slide. The press reports say more than $10 billion of window money was sourced from the UAE alone. a region whose remittance share is falling. This is not a diaspora suddenly saving more. That that is Lombard landing against Gulf property and portfolios coming back as deposits. So now we go move forward. Now to the part everyone calls the rejoice. On 14th of August, the headline stood at $716.9 billion. After weekly jump of 14 billion and then 10 billion, 7 straight weeks of gains, and we are within 12 billion of February's all-time record. But I want you to look underneath that number. Every dollar that came in through the swap window creates a matching forward liability. The RBI has to hand these dollars back. The net short forward position forward books stood at a record 106.6 billion at the end of the May. And end of June, it was $103.3 billion. And we are going to see the July data on 31st of August, and we are waiting for that. Through that number, we are going to know that how much our forward book has increased. So I would also like to pinpoint here is that the data might be it is taken from around the Economist Times and Business Standards data. So here the banks are borrowing for themselves. Seven deals on this table, $5.5 billion of offshore paper money that banks have uh, afflicted from the overseas lenders. And in total, Indian lenders has raised around 10 billion dollars for the year. Look at the pricing column, spreads of 88 to 100 and 8 basis points over the treasuries, the tightest in Indian bank spread since 2013. The 1.5% swap does the heavy lifting. It turns these dollar coupons into rupee funding below domestic cost. Two names deserve a pause. Kotak Mahindra, a debit issuer priced 650 million at T plus 108 on a 2 billion book. While HDFC raised around latest they raised around $1.75 billion at the order book of $7 billion, which is huge. So we will find out that it is going to run for around 31st of December, and we will see that how much money they are going to raise. Thank you so much.